Have you ever noticed something strange in the stock market? Why do so many investors buy fundamentally good companies and still end up losing money? The problem is usually not the company, it's the timing. Back in days, I have made these mistakes myself. I have chased stocks simply because everyone else was buying them, and almost every time I ended up buying near the top. Today, my entire investment framework itself works exactly the opposite. This one mistake can quickly destroy years of return. Not because of you chose a bad company, but because of you chose the right company but at the wrong price. And unfortunately, that's exactly what most retail people do it. Think about your own behavior. A stock hits all-time high. Suddenly, YouTube is full of that stock video. WhatsApp groups are discussing about it. News channels can't stop talking about it. Even your friends start asking, have you bought this stock? That's exactly when FOMO begins. And without realizing it, most people enter at the worst possible time. In this video, I'm going to show you why I avoid buying what's trending, why I actually look for the companies everyone has almost forgotten, and a simple framework I use to decide when a beaten down stock can be worth buying. By the end of this video, you will understand why some of the best investments never appeared in anyone's top stock to buy list. Let me take a very recent example with gold and silver. From 2023 bottom to 2026, gold has been rallying like anything. Gold touched its all-time high of 5,608 in Jan 2026 in US dollar terms. Silver was even more crazy. Silver actually gave 150% return in 2025 alone, and in January 2026, silver crossed more than $100 per ounce for first time in the history. In Indian rupee terms, gold touched 1,78,000 per 10 gram in January 2026. That's all-time high. And what was happening at that point in time? Every YouTube channel, every WhatsApp group, every news channel, and friends, left, right, center, everybody was talking about gold, silver, about buying it, buying it, buying it. This is exactly the moment I want you to pause and think. I'll put it like this. Whenever a stock or asset becomes too famous, that's actually the most dangerous zone to enter, always. Now, for gold and silver, there is no traditional PE valuations. I understand that. But 200-day moving average is one of the best supporting tool. Whenever gold or silver is trading way too far above the 200-day moving average, that's not the right time to buy. Why? Because of only one simple rule, mean reversion. This is the nature of stock market. What goes too far up has to come back down. We don't know exactly when it will come, but we know exactly it will come. That is certain. And see what is happening right now. Gold all-time high was 5,608 in 2026 January. Today, June 26 of 2026, gold is trading around $4,014. That's already 28% down from all-time high in USD terms. In Indian rupee terms, from 1,78,000 all-time high, gold is now around 1,40,000 per 10 grams. That is roughly around 22% down from all-time high in rupee terms. Now, this is the better place to think about any kind of accumulation. Not when everyone was screaming around 1.78 lakh all-time high for the gold. That was very dangerous zone. Same exact lesson applies to stocks also. Let me take you through the live examples. Trent. Trent is a fantastic company. Zudio, Westside, great business. There is no doubt in it. But look at the peak valuation. When Trent was its all-time high, 5,550 rupees in October 2024, the stock was trading at the PE of 218. That's not valuation. That's pure sentiment, pure trend chasing. And what happened? The mean reversion happened. By March 2026, trends fell to 2,260 rupees. That is 60% down from all-time high in around 17 months. What's the reason? Slow revenue growth. Q3 FY26 revenue grew only by 15% year on year, which was below the expectation. Same store sales were muted and the valuation were simply unsustainable. Even after 60% of the fall, the PE is still around 70 to 80 approx. This tells you how expensive it was at the top. Same story with Kaynes technology. In 2024, Kaynes gave 174% return, and in 2025 alone, it fell 50% from its peak. The PE was crossing 200 times. One bad news around the financial transparency concern and the stock, which took months to go up, came down in very few days. The same with Dixon Technologies. It was trading at the PE of 200 times in peak 2024, and it also corrected 45% from its all-time high. And early 2026, when earnings concerns and margin pressure and came, PE crashed to multiples of 50. See the pattern. To go up, stock uses the steps, but to come down, stock uses the lift. That is how high PE stocks behave. It goes up in step by step, little by little, but when it starts falling, it falls like non-stop red candles. So, even a good company at a wrong valuation is a bad buy. I personally use PE more than 70 as a threshold for me to signal it is high valued or undervalued. Above 70, I will definitely watch out, which means I don't run away, but I definitely don't rush in. Now, here is the interesting part, the reverse story. This is where I actually make money. Whenever a fundamentally good company falls sharply because of a temporary sentimental issue, that marks my shopping zone. Here is my rough framework for margin of safety using 200-day moving average and all-time high. If a large cap company falls 20% from all-time high and it is below the 200-day moving average, that's a good accumulation zone. If a mid-cap company falls 30 to 45% from all-time high and it's below 200-day moving average, then that marks the accumulation zone. If a small-cap company, it is 45 to 60% from all-time high and below 200-day moving average. That marks the good accumulation zone for me. Now, let me tell the live examples. Please do not consider this as any stock recommendation or advice because I am not a SEBI registered advisor. I am sharing my knowledge for the educational purpose of myself and my community members, and so I am sharing it to you also. So take this as an educational video and do your own analysis before taking any decision in stock market. Now, live examples I actually executed is Grindwell Norton. Grindwell Norton, quality abrasive and industrial company. All-time high was 2,900 around in July 2024. After that, it fell sharply by late 2024 and early 2025. It was trading around 1,300 to 1,600 levels, where it was 40 to 50% down from all-time high. The reason were China dumping in abrasive space was hurting the margins. Earnings were under pressure. Sentiment was completely crushed. Nobody was talking about it. That's exactly when I entered. And what happened now? As of now, Grindwell Norton is back around 2,200 to 2,250. Now, roughly around 35 to 40% of profit from where the low, where I bought. It has hit my target, so I am exiting now. So this is just a learning from my own practical trades. So consider this as an educational information. Same thing I did earlier with RR cable, for which I have put out already a video. If you want to see the video, please, I will attach the link in the description and I will put the card here. You can go and watch, and also in the Phenolics cables. Both were beaten down because of sector-wide fears around raw material cost and demand slowdown, and one of the competitor entering the market. I bought at the bottom when the bad news was at the peak, sold at the target of 30 to 35. Yeah, that makes a clean profit for me. That's how I work in stock market. Even I started as a beginner in 2020, but just on the course of time, I evolved myself with so much of learning. If you want to take a practical decision in stock market, like whatever we are discussing, I run personalized cohort where I help my friends and family in just educating them with whatever 6 years of experience has taught me. So if you are interested, please check out the link in the description, join the community and observe what this community is doing to make an ordinary person into an extraordinary investor. Going back to the video, let me be very clear with the framework I use in the market. Step 1, find the beaten down quality company. I look for the companies that has fallen 20 to 50% from highs purely because of sentiment or temporary issue, not because of the business or not because of financials, where it is permanently broken. Step 2, check for the fundamentals. P, is it now at a reasonable level, below 70, which is a comfortable zone for me? And more than that, ROCE. I want at least 15 to 20% of the ROCE to qualify that as a good company. And always sales all-time high and profit all-time high. If the business is growing in terms of revenue and the financials are growing in terms of profit, then it's all good for me to consider that stock for further analysis. Step 3, check the 200-day moving average. How far below is the stock from 200-day moving average? If it is 10%, 20%, 30%, the farther below in a quality company, the more the margin of safety I have. Step 4, define the target before entering. I target the recent all-time high or a fair value of PE justified level. I set the target and stick to it. When the target is hit, I exit without having a second thought and move my money to another beaten down quality stock. This is literally my entire framework in simple words, which is repeatable, compounding, and it is giving me money. See, people always say, don't catch a falling knife. Yes, I agree fully. Don't catch a falling knife that is still falling. But once the knife has fallen and it's lying on the floor and the business is fundamentally strong, you can absolutely pick it safely, and that is what margin of safety means. The safety equipment you wear is good fundamentals, 200-day moving average, support zone, and reasonable PE. I'll be very honest with you. I don't believe in buying the stocks at the breakout, and the reason is very simple. When the gold was breaking out, everyone was buying, and it is now 28% down from all-time high. When the Trent was breaking out, the PE was more than 200, everyone was buying, and it fell 57%. The problem with breakout buying is I don't know when to sell, because when it is going up, the FOMO is saying it can still go higher, and when it falls like a lift, fast, no time to react for me. But when I buy the beaten down, I know my entry, I know my target, I know my exit, clean, no emotion, no FOMO. Enter when nobody wants to go, exit when everybody wants to come in. That is the game I usually play, which is giving me money. So what's the simple lesson from today? 1. Don't chase the trend. Gold at 1.78 lakh, Trent at PE of 218, Kaynes at PE of more than 200. When everyone is talking about it, the risk is at the peak. Second, mean reversion. That is real. PE will have to come down, price will have to come down, always it happens. 3. Your opportunity comes in the silence. When nobody is talking about the stock, when the news is throwing all the bad news and the sentiment is crushed, that's your actual shopping window, like Grindwell Norton for me. 4. Have a framework. PE below 70, ROCE above 15, below 200-day moving average, and so margin of safety is in your favor. 5. Decide your exit before you enter. Target the recent all-time high, stick to it, exit, and move on to the next stock. Now, if you want to learn this framework properly with respect to technical charts, with respect to fundamental, with respect to risk management, I have built a personalized cohort for my friends and family, and right now I have started expanding to the YouTube community. In fact, I'm very happy to announce this. Last time when the introduction session of that cohort happened, 9 people from YouTube community has joined to understand what I'm going to tell, and out of 9 people, 7 people have signed up for the cohort, and right now they are in the part of July cohort. Honestly, that is an opportunity to serve them with all my learnings of 6 years. But what took them to take a decision is a 3-hour introduction session where I teach an exact large cap strategy, which is my bread and butter in long-term investing. You can backtest it, compare it with the returns of most of the mutual fund, and you will find it very interesting. For the first few days, I thought I will give it at the free of cost, and after a few days, there will be a small payment to access it. So if you are interested, the link is in the description. Fill out the form and join the community to get access. And if you have found a value in this video, please subscribe to the channel and hit the bell icon. One simple message I would like to leave you with is, don't be the last person to enter the party. Be the one who arrives when the party hall is empty, buy the ticket cheap, and sell when the crowd is rushing in. Thank you for your time. Thank you for your patience. Happy investing.